Can we expect a decent year in 2023?
Hey, good morning, Dom. Happy Friday and happy almost 2023. And what's interesting about the survey results is that there's a pretty wide tail, or not wide tail, a wide distribution. And I think that's reflective of just the uncertainty that we have heading into 2023. It feels good to see people being more positive on equity markets. It's certainly been a lousy 2022 from a return perspective, but also an investor pessimism perspective. So I think people want to be more optimistic. But what I've been telling our clients is that volatility is here to stay, at least with the first half of 2023, because there's still uncertainty with respect to where terminal rates are going to go. There's still uncertainty as we get this clash of narratives of peak inflation intersecting with a potential economic slowdown. And we've got to work through that. And that's why I've been so adamant for the past, really for most of this year, and especially heading into next year, to maintain a core defensive bias. It pays to lean into higher quality companies, into companies with dividend growth at a reasonable price. Those parts of the market have been outperforming not only on the downside, but also on the upside. So you're not giving away much in terms of market exposure by keeping that defensive bias. And for investors that might want to be more aggressive and really lean into capital markets, given what could be a great long-term opportunity, small cap equities in the US, to me, look the most interesting right now for a number of compelling reasons.
So Matt, I mean, okay, so because I'm paid to ask questions and to oftentimes be devil's advocate and kind of push back on certain things. I've lost track, Matt, of how many folks, analysts and strategists that we've had on our air over the last several weeks who are all saying the exact same thing you are, that they're expecting it to be a very choppy, perhaps downside kind of bias first quarter or half of the year and setting up for a decent one in the second half of the year. If that has now become consensus, let's say hypothetically, what's to stop people from saying, you know what, let's get in now and then drive that whole narrative kind of by the wayside and we could actually see a rally in the first 3 months of the year?
I'd welcome a rally in the first 3 months of the year. And I think that's why leaning into certain sectors, especially larger cap healthcare, leaning into GARP growth at a reasonable price, dividend growers, you're still defensive with respect to your positioning, but those parts of the market have worked on the upside. They worked during the rally we had from the lows in mid-October through the local peak we had towards the beginning of December. So being defensive still helped you capture upside exposure. But the reason I think why myself and many other strategists are more pessimistic in the beginning of next year is because the market still hasn't caught up to the Fed. I don't know why the market keeps expecting the Fed to have this big pivot when that narrative has not played out so far this year. Yes, the economy is going to slow, but in my opinion, we're probably going to have a real recession, not a nominal recession, meaning that we're still going to have nominal growth. And so the scale of the recession probably isn't going to be as deep or as dark as a lot of people are expecting. And that gives the Fed the ability to reach its terminal rates. It's been very, very consistent in saying rates are going to be higher for longer. And the market still hasn't caught up to that. And that's the key reason why I think we're still going to be choppy and still likely to see some downside volatility earlier next year, because the market has to catch up to what the Fed is doing.